would it not make sense to compare the couple of trading plans that we have seen so that we can make a decision for ourselves which of these plans is more suitable for our trading style? Or maybe what we can do is we can prepare our own trading plan which suits our personality and our trading style. But these two plans are like proxies of the trading plans that you can prepare for yourself. I highly recommend that you prepare your own trading plan and not rely on someone else's, because your personality, your style, your aggression is very different from other people. So prepare your own trading plan and test it on sample sizes of 20. Okay, if it works on one sample size, try it on another sample size. If it works, then try it again on the third one. If it doesn't work, then you can use that feedback loop, try to make some tweaks. Of course, don't vary too much from your natural trading style. Okay, so we will look at these, we will try to compare the trading plan of John and Lisa, and we'll see how different they are in their approach. But if you see that there is one thing common between both of these trading plans, although they look very different, and the thing that is common between both John's and Lisa's trading plan is that they both know what they are doing. They know exactly what to do when the day starts. They know exactly what to do when the market session closes. Okay, so here we will compare the plan of John and Lisa. So first, the market that John has chosen is Forex and Lisa has chosen stocks. Now, this doesn't mean that John is better at Forex and Lisa is better at stocks. If Lisa had chosen Forex, she would have done quite as well as she is doing with stocks, because when we are trading the charts, we are giving no importance to the market news, we are giving no importance to the fundamental analysis. We are assuming that all of the public and private information of the markets is already priced in. So the price is everything for a pure technical trader. So John is just naturally inclined to trade Forex, so that is why he has chosen Forex. And Lisa, since her childhood, she has been fascinated with stocks, and maybe she has seen some of her family members trade stocks. So that is why she is naturally inclined towards trading stocks intraday. So there is nothing special about choosing Forex or choosing stocks. It's just that they are naturally inclined, and that is the reason why they have made that choice. And it is true that irrespective of whichever market you choose, if technically you are a sound trader, you are likely to do well irrespective of the trading vehicle that you choose to trade. Now, the trading style that they have chosen is John is a positional trader and Lisa is an intraday trader. This is very important. This really depends on your personal circumstances. Now, if you are working at a 9 to 5 job, the chances are very low that you will choose the intraday option, because this requires you to be on your toes. Moreover, when you are trading intraday, you are likely trading smaller time frame. And you remember the golden rule: the higher the time frame, the more is the reward to risk. The lower the time frame, the lower is the reward to risk that is available to you, because on a 15-minute chart there will be more ups and downs in the market, but if you compare that to a weekly chart, you are less likely to see a lot of ups and downs. So this really depends on your personal circumstances. If you have the time to do intraday, of course go for an intraday. If you don't have the time to do intraday, you go for positional. In fact, I have seen a lot of traders who are beyond intraday and positional. There are some traders who only trade the weeklies. Now, that by definition, that is not intraday, it is positional. But even in positional, you are going one step further and trading only the weeklies. I have rarely seen somebody who is only trading the monthlies. That is not trading. That I would call that investing. So if you are trading only the weeklies, okay, you are going really one step further, and these traders do well, by the way, provided their fundamentals are strong. Now, if you see for John, the number of trading vehicles available are less. He is basically trading only 4 markets, and even in those 4 markets the INR is the common denominator. So you have to go in depth as far as analysis is concerned. But in the case of Lisa, she is using the method of elimination, right? So she doesn't need to go into lot more detailed analysis of each chart, as we have seen when we looked at both these case studies. She is basically taking 100 stocks and eliminating as many stocks as she can. She is trying to find the smallest reasons to reject stocks rather than select stocks for intraday. So that is the reason why she has the range of opportunities available for her is more than the range of opportunities available for John, and we have quantified those opportunities as well when we looked at these case studies. Coming to reward to risk, the fact that the reward to risk ratio for Lisa is low demands that she is good at her success rate. Her success rate needs to be high for her to make money. So her success rate needs to be 40% if she wants to make money at that reward to risk. And in the risk management module, we have seen the levels of traders, we have also seen the success rate, we have also seen the correlation between the success rate and the reward to risk ratio at a particular reward to risk ratio. That is very important. When you compare reward to risk and success rate, you need to fix the reward to risk ratio. So for example, at a given reward to risk ratio of 2.5, what is the table look like? What success rate you need at this particular reward to risk ratio in order to make money? That is the question you need to ask, and I would recommend that you go back to the risk management module and study that concept. This is the very important, this is the secret of professional trading. All professional traders know this concept, and all amateur traders do not know how to trade the reward to risk ratio. As far as monitoring is concerned, obviously Lisa has to be on her toes. If she finds the smallest reason to exit a particular trade, she must exit. Okay. As far as monitoring is concerned for John, he just needs to look at the charts every 3 hours. He can do that even on his mobile phone, but mobile phone trading is not recommended at all for Lisa, because she needs to be in front of the charts, in front of her laptop or in front of her big monitor screen, because this is something that is full time for her. She is investing 6 hours of her time daily, maybe more than 6 hours. So she needs to be very watchful of the prices in the market. Of course, the fact that you have a few trading vehicles, your opportunities are going to be lesser than the opportunities that Lisa has. So, and we have quantified these opportunities as well. So that is the main difference. The number of opportunities available for John are less. So he needs to be very selective about his trades. Lisa can be a more liberal. She is looking at 100 stocks per day. So she needs to be careful. She needs to be very selective. She needs to be using the method of elimination and try to narrow down on her stock selection process, which she chooses to do intraday. And of course, the time frame, 3 hours is the minimum time frame. He can't go below that because he doesn't have time to do trading all day. 15 minutes is the lowest time frame for Lisa. She can't go to 10 minutes, 5 minutes and 2 minutes and 1 minute chart. 15 minutes is manageable for her. Maybe she can check the charts every 15 minutes. Maybe she can check them every half an hour. She might have some levels marked on her chart, so that when the prices start approaching those levels, only then she can start looking at or monitoring those charts. She doesn't really need to sit and look at these charts every 15 minutes. Then she would have to look at all the stocks 25 times per day. That's asking too much from her. So she might have some levels marked on her charts and then watch the market when the price approaches that level. In the next video, we will continue with this comparison.